Hello from Bloomberg House. This is a special edition of Open Interest. I'm Dani Berger. We are in the heart of the Miami Design District as Formula One takes over the city. Matt Miller, he's close by, but currently preparing to kick off the day of high-profile interviews that will include the CEO of the Audi Revolut F1 team, and I'll also be sitting down with Thoma Bravo managing partner Orlando Bravo, and in just minutes from now, Scott Rubner from Citadel Securities. But first, let's check on stocks after a day of heavy news flow, including the mega earnings session. Meta and Alphabet are each adding $10 billion to their AI spend. Amazon and Microsoft are seeing major growth in cloud sales. Mag 7 AI capex in 2026 is on pace to top $700 billion. Only Alphabet, though, gaining. Meta down as much as 9%. At one point was down 10% at the open. Let's also look across assets, though, because oil has touched its wartime high. Iran's supreme leader vowed to dismantle the U.S. presence in the Strait of Hormuz and guard its nuclear capabilities, like its border. Also, reports coming from Axios that Trump is maybe considering other military actions. And add on top of all of that, a Fed rate decision yesterday where you did have some dissent towards the hawkish direction. But still, it's a market dominated by the Mag 7 earnings late yesterday. Joining me here to discuss that and much more, I'm pleased to say it's Citadel Securities Head of Equity and Equity Derivatives Strategy, Scott Rubner. Scott, thank you so much for joining.
Good morning.
Lovely to be in your town, beautiful, sunny Miami.
Thank you.
So, okay, first of all, I know you called this the Super Bowl of earnings week, and that it was. I feel like it was like a giant middle finger to traders for all of these companies to decide within 80 seconds of each other to report. Just how difficult is this for the market to absorb these big consequential earnings coming from these companies that are uplifting capex and kind of the entire economy of the United States?
Yeah, so we are not seeing any decline in spend and demand for AI. As we mentioned, it was the Super Bowl of earnings last night. By the end of the week, 66% of the market cap of S&P will have reported Q1 earnings. And from us, it's a very positive sign on the tech industry. And the way that you invest in the U.S. equity market is one of high quality, high demand, high free cash flow, and it's unlike any world in the globe.
So if these are so attractive, why do we see swings like Meta down 9.5% on the day after it reports?
Yeah, so I would say that if I look at the run up into earnings and I take the semiconductor index, it rallied 19% over 19 days. And I think we're not seeing any real pullback in these names, despite the move in Meta. But I would just say when I look at equity futures today hitting a new all-time high, there's a big shift from what was a technical driver in March to one that is a fundamental driver in April.
How do you distinguish that? Because I could, for example, look at that OpenAI news on the Wall Street Journal that perhaps are not hitting their internal targets, and you get tech that sells off. And it wasn't just tech, it was like a momentum basket.
Yes.
Does really poorly. So on days like that, when it's selling, how much of that is fundamentals in the driver's seat, and how much of that is just taking some of the air out of the momentum trade?
I think the article happened to hit at an all-time high point in the momentum factor. I think that baskets are trading in the market more than ever before. So it was orderly to me. It was a buying opportunity. It was one that was factor driven, but it didn't change any views on the fundamental side.
Is it fair to say, though, that a lot of these pullbacks are just buying opportunities, especially for these quality big cap tech companies?
From our retail clients, we're really seeing that dynamic. So if I look at on Monday, we had our retail demand in the 94th percentile over the last 5 years. So I think when there is a sell-off, right now, it's a buying opportunity, especially in the U.S. mega-cap tech stocks.
Has that been the case through this volatility, through the war in Iran? Are we seeing retail still buying the dip?
So I think that's a great question, where you had retail really playing defense around tax day. April 15th was a big day where they were playing more defense and less offense. We've seen this completely change. So retail had a very good trading year in 2025. We execute between 35 and 40% of all retail flow, so we see this with data-driven insights. But now retail moved back into the driver's seat after especially One Big Beautiful Bill Act and tax refund checks hitting the accounts. I think we're seeing a return from retail it's no longer meme stock trading, but it's one that is, they're driving the price action.
What does that mean for supply demand? And you're always really brilliant here, because if you have retail buybacks coming back, hedge funds still participating, is there a real imbalance that could push stocks higher?
There's a supply and demand mismatch right now, Dani. So when I look at corporate earnings, given that you mentioned it, so next week starts the start of the buyback window for corporates. If I look at U.S. corporates, they authorized $544 billion year to date, over $1 trillion worth of repurchases this year. It'll be the largest year on record. So stock certificates are now a rare commodity again. And, by my calculation, I see about $5 billion worth of corporate demand every day during the open window, which negates some sort of the selling pressure. So U.S. corporates, again, are the biggest buyer of the stock market, and U.S. corporate CEOs are showing strength in their views on the market.
If I just took everything you just said, it's very easy to be incredibly bullish on this market, and it's indeed not just easy, but logical. But then another part of my brain, Scott, goes to oil trading at 4-year highs, yields moving higher, 30-year yields surpassing 5%, and at the same time, the VIX is 18. It does feel like a bit of a disconnect. Is that fair? Is there some irrational exuberance in markets that other macro cross assets aren't really reflecting as well?
Yeah, so the way that I view both cross asset volatility and oil prices, you mentioned the 30-year bond hitting 5%. So there's a lot of reasons to run this wall of worry, especially on the software side and private credit. But when I look at the participation of who is trading the equity market, it's almost a macroeconomic indicator. When I think about the bottom 50 percentile of wealth demographics, we've seen equity exposure ramp by 300% since 2022. So it's almost a resilient consumer, one that grew up on the trading apps, trading all of the exchanges and after hours type of volumes, that to me is, as long as there's no displacements from AI in the jobs world, it's something that we're really bullish on.
Can I tell you why I love that? Because we look at a lot of things like University of Michigan, and sentiment looks really poor.
Yep.
So I feel like this is a better way to kind of gauge, because it's a consumer that keeps spending and clearly continues to buy stocks too.
We actually have our own sentiment indicator that we started publishing. Citadel Securities executes between around 24% of the U.S. exchange on a daily basis. And what I find with our indicators is we're actually real-time back testing this on data. And our indicators are a lot more euphoric than what the sentiment indicators that we've seen.
Did they take any hit with higher oil prices and the war in Iran?
I would say that it was a quick mechanical-led sell-off in March. It was very robotic on degrossing portfolios among institutional investors, but our retail clients were actually, slowly entering into the market, and, we've rallied pretty aggressively since then.
By the way, since degrossing, have institutions regrossed up? Where do they stand in exposure?
Yeah, that's a good question. So hedge funds, gross exposure, which is basically longs plus shorts, if I look at back to March, was at an all-time highs led by the shorts. And if I look at net exposure, which is longs minus shorts, that was at lifetime lows. So you had this dramatic need to hedge based on rules. So it was shorting ETFs, it was shorting index futures, it was buying put options. That all happened in March. The market heals dramatically since then. Hedge funds are slowly participating on the way up, but retail's really the price setter in the market.
By the way, what difference does it make, I guess both for institutions and for retail, to have these huge IPOs coming to market? So much has already been said about the concentration in tech. And now we're about to get $800, $900 billion companies, even more when it comes to SpaceX. What difference does that make to have such a change in the composition of this equity market?
So when you think about the S&P 500, if you allocate $1 into the SPY ETF, 35 cents goes into the Mag 7, 40 cents goes into the top 10 stocks. When you think of what percentage of the U.S. equity market is AI or AI adjacent, it's 45 cents of every dollar. So when I see the distribution, I find the U.S. market remains very robust in terms of rebalancing. So there will be some of the big names have to be sold to make room for new IPOs. We've done a number of work on this, but it's not a net negative. It's something that is based on all of these passive flows that go into the U.S. market, based on target date strategies that make all companies higher in a market capitalization basis. So when they enter the market and go into these big indices, it's actually quite bullish for the U.S. versus the rest of the world.
Interesting. So if you were running a portfolio and you'd want to kind of prepare for this, like what do you advise?
It's one that naturally the biggest weights need to be sold to make room for these new IPOs. The interesting dynamic is that retail will actually get a decent slug of the IPO allocation, and this is a new phenomenon in 2026, something that we're actually quite passionate about. But needing to make room is one that, dollar for dollar, it's net neutral, but some of the big ones have to be sold to make room for the new IPOs.
Hey, Scott, we're almost out of time, but I feel like I'd be remiss if I didn't ask about the setting that we're in right now. I want to leave the politics aside because there's some weird politics about New York and living there and working down here in Miami.
Yeah.
You've been in the area for a long time. What is it like to be, at the helm of one of the greatest financial firms in America and operating here out of Miami?
It's really exciting. And if I take a look on the professional side, I just came down from a macro investor forum that we hosted in Palm Beach, where a lot of former central bankers and thought leaders spoke. So we had all of our institutional clients in town on the macro side. 2 weeks ago, we hosted our 20th annual retail trading summit. So it's very interesting to have all of the clients come down to Miami and South Florida and talk about the intersection of culture, politics, our firm's leadership here. And on the personal side, it's really great to be able to coach my kids' baseball team tonight, run the pitching machine, and interview Mario Draghi in the same week. So for me, culture...
Are you interviewing Mario Draghi?
He was just at our conference in Palm Beach this week.
Very cool.
As well as other thought leaders. So I would say we actually have clients wanting to know what we're up to in Miami. We have a lot of interest, and I expect that to continue.
And I also expect every time they come down here, they do that thing where they're like, why don't I live here? I need to pick up and move.
It happens a few times.
Yeah, I'm feeling a little bit of that right now. Scott, thank you so much for joining us. We really appreciate it. That is, of course, Citadel Securities Head of Equity and Equity Derivatives Strategy, Scott Rubner. Now, to earnings, which we were just discussing with Scott, let's get to some of those details because Apple is set to report after the bell. Alphabet, Meta, Amazon, and Microsoft, they all reported yesterday, with Meta lagging peers on an AI payoff. Bloomberg Tech co-host Ed Ludlow joins us now. Ed, if you were to wrap all of these together, the 80 seconds where we had huge amounts of information coming in, what would you say is your takeaway?
71 seconds, by the way. 4:01 Eastern to 4:02 Eastern, 11 seconds. That's when they all hit. The capital expenditure was the swing factor. We knew that was going to be the case. So in aggregate across the four names, capital expenditures in 26 will be $725 billion. Amazon, Microsoft, and Alphabet all had statistics to show that there's a payoff on the other side. Principally growth in their cloud units, 28% for AWS, 40% for Microsoft Azure, 63% for Google Cloud, which is doing astonishingly well. And they had other data to show that they have meaningful AI products and sales channels that are working. Meta raised CapEx guidance, $125 to $145 billion this year. Revenue was strong in the quarter gone. The outlook for the current period on sales in line with consensus, but then there was not that extra thing. And by the way, when you were in that conversation with Scott, brilliant conversation, markets turned negative briefly. Meta's the biggest drag, but it's interesting that Nvidia is down significantly and the second biggest points drag, because you'd think that raised aggregate CapEx, they'd be the biggest beneficiary.
What about when Apple reports later, Ed? What are we expecting there?
Yeah, it's, I don't know that it's going to be the Earnmageddon of last night. The capital expenditure story of Apple is not the same. It is about product and AI success in actually getting a meaningful piece of software into the hands of the consumer. But of course, this is the first earnings report since Tim Cook announced he'd be stepping down as CEO effective September 1st, and John Turnus, who's the hardware chief, becomes CEO effective September 1st. And they did that deliberately so they'd have a couple of quarters to communicate what's going to happen. And so that likely will be the story.
All right, Ed, thank you very much for that. Bloomberg Tech's Ed Ludlow. And just want to point out that later on Bloomberg Tech, Ed and team will be speaking to Qualcomm CEO Cristiano Amon. So stay with them for that conversation. Again, Bloomberg Tech kicks off at 11 a.m. Now, a deeper division at the Fed, our other top story of the morning. The central bank held rates steady, but three officials went against an easing bias amid increased uncertainty fueled by the war in Iran. Here's what Chair Jerome Powell said.
Number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
And a host of economic data out this morning. So much to cover. Joining us to do that is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, I'm not exactly sure where we should start. There's the decision itself. There's Chair Powell staying on. What was kind of like the big message that traders got from yesterday? Maybe let's start on the decision itself.
Well, the decision itself was totally expected. The idea that the Fed would do nothing because they don't know what's going to be happening with the economy, with oil prices. They don't know when the war is going to last, and they don't know what additional tariffs are coming. And that was the point that Jay Powell made at the news conference. You can't really move policy if you don't have an idea of what you're moving it for. Now, in terms of Powell and staying on, and he basically made the case that he doesn't trust the Department of Justice. He wants to make sure that he is not in legal jeopardy before he leaves. So he'll stay probably through the Inspector General's report. Now, the question about the dissents is one of the most interesting things for the markets. Do those people want to raise rates? Are they really leaning in that direction? Or is this sort of a message to Kevin Warsh that when he comes in, he won't be able to immediately implement the president's wishes for lower rates?
There is this feeling around the world, and just in the ECB and BOE decision we got, whether it be the BOE and this idea that the energy shock is too big, with Europe, Madam Christine Lagarde talking about that rate hikes were something that were discussed. Yes, that region has a bigger energy shock, but Mike, is there not some degree where that policy, and obviously it necessarily affects the U.S. one, that those conversations of hiking are happening in Europe?
They are happening in Europe, and they happened at the Bank of England as well, and both banks decided to hold. The difference being that they're going to feel second-round effects more quickly than in the U.S. Fed is going to be waiting to see if oil prices get into other prices and start raising the cost for consumers for other goods, for businesses for other goods. They haven't seen that yet. They think it may happen, which is why some of them are nervous about whether rates are in the right position. But until they have a better idea, the president could come out tomorrow and say that the war is over and oil prices start coming back down again. Until they have a better idea of what's going to happen, they're going to stay sidelined, whereas the European Bank is sidelined right now. They're just expressing more concern about how quickly the effects of the war could hit them. And they did discuss raising rates if it were necessary, and Powell said they did not discuss that at the Fed meeting. So we're a little bit behind in terms of timing, but everybody has the same concerns going forward.
And then at the same time, Mike, economic data today, a grab bag from personal spending to GDP to jobless claims. Still looks like a picture of resiliency and strength for this American economy.
Yeah, I got a whole bunch of charts and numbers that I won't bother to go through because there's so much of it. But there were some wild figures like...
We love your charts, Mike.
There were some wild figures like the lowest jobless claims, 189,000 since September of 1969. Companies just not doing anything right now. And I think the number that caught a lot of people's attention was GDP. Came in lower than expected at 2%, but the underlying details weren't all that bad. Consumer spending slowed down. It generally does in the first quarter after the holidays, and it has been strong for a long period of time. But it was business spending that really stood out. Business investment up 10.4%. Equipment spending up 17.2%. Intellectual property up 13%. It's like the old movie Broadcast News. Ed Ludlow says it there about the earnings, and it shows up here in GDP. All those companies doing really well, plus 21% increase in imports. Most of that computer supplies. So a lot of strength underneath on the business side. The hope is that consumers can hang in there. The question is, do they, to bring it back to the beginning of the discussion, do they, with gas prices rising ever higher?
I just wonder also when you look at the GDP data, Mike, and couple that with earnings from the big hyperscalers and all that they're spending on AI, just how crucial that continues to look to have growth continue at pace.
Well, it's what's holding up the economy right now. We did have a rebound in government spending from the government shutdown, but that'll go away next month. So it's really business spending that is the strength of the economy at the moment. And the fear is that consumer spending, which is 2/3 of the economy, is going to weaken even further because of gas prices. And then the business spending won't be able to offset it. So that's what everybody is watching for as we go forward. We did have, in terms of spending in the month of March, fairly healthy, 0.9% gain. So maybe consumers can look through the gas prices for now. That's going to be the real issue going forward that you have to watch. And we, of course, have the question of inflation. Inflation up to 3.5% for the PCE in March, 3.2% for core, way away from the Fed's target.
Mike, thank you so much. Bloomberg's Michael McKee there. And also just to reemphasize what Scott said, that their sentiment indicators internally at Citadel show that sentiment has been high, as evidenced by retail investor buying. And you are looking at an S&P that is lower on the morning. It's being dragged down by Meta, which is off nearly 9.5%. The S&P 500, little changed. The NASDAQ is down 0.4%. 10-year yields, those are falling. It was about higher yields yesterday, fears of stagflation, but maybe at the moment it's more of a growth fear. Brent crude, that's at 114, down 3%. It was just trading at a 4-year high yesterday on fears that there could be escalation. Coming up in the show, we are going to hear from Audi, the F1 team, Audi Revolut. Matt Miller will be joining them on stage. That's coming up just after this commercial break. You're watching Bloomberg live from Miami. Matt Miller is sitting down with Mattia Binotto, Audi Revolut F1 team CEO and team principal. And I'll be heading off to speak with the founder of Thoma Bravo, Orlando Bravo. But for now, let's go straight to Matt and the CEO of Audi Revolut's F1 team.
1 year that Ferrari was not winning a title. In the following years, and with Michael, we won in total 16 titles between drivers and constructors. So it has been an incredible period. As I said, I've been lucky to be part of that era, because success is when you achieve it through big efforts. It's somehow incredible. Now, to the second part of the question is how different it was and what has been the journey with F1. So F1 was very different at the time. So still it's about racing, car racing, drivers on track.
It was also difficult, I imagine.
It was also difficult, yeah. But it was about fuel and lubes. It was really a sporting and technical challenge. Today it has turned to be more and more an entertainment. It's more fun for the persons and the fans watching the F1. It's, and you can see the business had grown up incredibly. At the time when we were winning with Ferrari, as I said, it was total 600 people in a team like Ferrari. Today it's more than 1,500 people, so more than double. The budget maybe 200 million per season. Today is over more than 500 million per season. So it's the complexity of the product, the number of races, the business in itself, fan engagement, media. It's a different world. So, and the complexity in itself as well, managing those teams today certainly has increased. But myself, as I said, being very lucky to be part of that journey at the time. Success, but not only, as I said, it has been for me a school. And which today, again, by leading the Audi F1 project, certainly I've got benefits from it.
So what is it like to go from, a team that already was world famous in racing? I mean, clearly it doesn't get any bigger than Ferrari and Jean Todt, to building a team almost from scratch. I mean, I know that the Audi team is a new entrant, but you bought a team that already existed, but you're still having to go out there and find the Mattia Binottos of today, right, to hire. And there must be, because the budgets have more than doubled, a massive talent war, right? Also, the organization is just so much bigger and more complex, even before you get to talking about the cars. What is it like to build that kind of organization from scratch?
It's our biggest challenge today, to become a winning team. Audi has participated to most of the motorsports series by winning. The most famous is Le Mans Endurance, Dakar, Rally, introducing at the time the Audi Quattro, and for the very first time the four-wheel drives in a motorsport and in a racing environment. So Audi is used to win in the motorsports, but F1 is the pinnacle of the motorsports. It's a different league. The cars are different animals, and the complexity are certainly a lot higher. And as well, if you look, what are the competitors? Monsters, Mercedes, Ferrari, McLaren, all established organizations in F1, with all the proper assets, infrastructures, organizations. So the challenge now is the most difficult for Audi. And we want to win. We want again showing that Audi is Vorsprung, by the way. It's innovation. And we want to come, join, and win in our way. Now, as you said, the challenge is to transform what was a former private small team in a winning team. And sometimes it's even more difficult than starting from scratch, because then you are a small team with the wrong culture, the wrong mindset. They were simply used to participate, not to spend money, to count money. But now is the time that we have to become the best in class in that series, in that world. So we need to invest on our future. We need to invest on the talents, as you said. Ferrari did it at the time when I joined myself. Ferrari in 1995 invested in 15 new young engineers. I was one of those. And we are exactly doing the same. So now we are investing on very young graduates for the future. It's an investment on the future because we believe that will be for us a key pillar of our success. And we are investing on diversity. Because if at the time the young people were certainly an important factor for the success, I believe that today diversity as well. And what's diversity we can stay here discussing for a while, but diversity in thinking, it's diversity in innovation, it's really different nationality, different genders, whatever you can, because the sport has become so complex and the decision-making process is so important that young talents, skills, and diversity for me are the pillars of the future. So we are hiring, as you said, as much as we can. Why as much as we can? Because there is a budget cap in F1. So you are capped in terms of money that you can spend through the season, and salaries are part of the cap. So you need to balance between car development, pure techniques, investments, general services, but salaries as well. No? So that's why I think that's the balance we need. But investing on, as I said, young graduates, young people is where we are trying to do, to create our foundation.
By the way, two questions out of that. One is, as you said, you're from Switzerland. Did you go and you went and studied in Bologna after that, right? Or just moved down to Italy? Because I'm wondering what universities you tap to get your talent. And a related question is, if you're tapping people from Switzerland and your headquarters are there, doesn't that put you at a disadvantage for the price cap since other teams are in far less expensive locations?
So our location is expensive. I grew up and I studied myself in Switzerland, by the way, but we are hiring people not only from Switzerland, we are hiring people from around the world, looking at the best in class. We have created our own engineering academy in our team, Audi F1 team, where we are going through an important, let me say, assessment when recruiting those candidates. The last year has been the very first edition of our engineering academy, more than 6,000 applications for 6 engineers at the end. So it has been a big assessment. But yes, living in Switzerland is costly. The salaries in Switzerland are higher than the other teams, maybe in UK and Italy. But the current financial regulation in F1 are considering that difference. So we've got an allowance for the delta cost of the living in Switzerland. So that's why that is somehow balanced the extra, let me say, cost of life in Switzerland. But investing on young is bringing new energy, creativity, skills, talent, but as well it's a strategic approach to the salary level as well.
Does it make, I was inspired by the Quattro success. When I bought my first car, when I got my first job, I was living in Frankfurt and I picked an Audi A4 Avant with the 2.5-liter TDI and a stick shift. It was a great vehicle. Vorsprung durch Technik convinced me. Is it a different feeling to work for a team that makes cars people can actually buy? Because Ferraris, I mean, unless you live in Miami, you can't afford a Ferrari, right? Mm-hmm. You guys, I'm sure, have all got Ferraris, but most people can't. And so it's so cool that you can work for a team now that the fans can actually drive the product.
After 28 years in Ferrari, I'm Italian. I grew up in Switzerland, but I'm Italian. Certainly Ferrari for me was my passion. I was a Ferrari fan. And when joining Ferrari for me was the best I could do, a dream. So when I left Ferrari, what should I do, really? Should I still continue working in F1? Should I move to another team? Mercedes was my competitor, McLaren. I would never do it. And Audi came. No, true. And finally, Audi joined F1. And first, as you said, for what the brands represent. Now it's a big brand in motorsports. Second, I think is the most exciting challenge today in F1. Starting almost from scratch. Not only the chassis, but as well the power unit, with a clear commitment from the full Audi board and the full, I would say, corporate in there in Ingolstadt. It's a big project, it's the most exciting, and it's Audi, where, as you said, most of the people may buy an Audi. So by transforming that journey in a success and a successful team, I think that will be my best project in the life. So after Ferrari, honestly, that has been the only one which I have, as a matter of fact, considered. And as you said, it's for everyone. No? It's everyone can reflect into the Audi project and in our team.
What do you think of the new formula, the new regulations? You described it as, an engineering project that's turned into like an entertainment product. I always think of it as a limit driving sport that has gone to become a resource management sport. I don't know how many times I hear the announcers say energy harvesting. And as a fan, I'm not totally in love with it, I'll be honest with you. Although I think the races have gotten better and better. China was much better than Melbourne, and Japan, for a viewer, was way more interesting than those two. And there are going to be some changes here. So what do you think about that? Having, been around when the driver mattered most, and now it's like how much battery you've got.
As first, what's the DNA of F1? It's entertainment, it's sports, but it's a technical challenge. And F1 want to be it's a platform of innovation. It's a platform for innovation for manufacturers. It's a platform for innovations in general. We are at the edge of the technology. So reviewing the previous regulation was necessary as well. When we introduced the previous one in 2014 with the electrification of the power unit, already it has been a big step forward with the highest efficient engine in the world, somehow in F1, maybe even not properly promoted, but it was the most efficient engines we had. And now is the next step forward, and I think as F1 we have to do it. Now, I know that when you start introducing a new regulation, you may have things that are not perfect at the start, that need to be improved. That's everything you do when new improvements are required. But the overall format is still a great format. As you said, watching races that are overtaking. We should not forget that at the early 2000s, the races were boring with no overtaking. And here maybe there are nostalgic saying that before it was better. But before, people were even vocally saying it's not great, no overtaking, it's boring. Now we've got a great show. And I think the show is great, by the way. As you said, overtaking, racers, drivers fighting on track. It needs to be fine-tuned. Yes, it needs to be fine-tuned, but that's fine-tuning that we are going through. But I think, as I said, it's a great platform. Energy is part of the automotive today. So and I think it's how the drivers have been very vocal that it was not so great. So the fans are catching it up. Media are telling it. But once we have fine-tuned and no one will discuss it anymore, you simply focus on the show, entertainment, and the overtakings you got on track. And I think it's a big show.
How are your drivers? I mean, you have in Nico Hülkenberg, a driver who has experience in not only this league, but also, with the previous driving style. And then Gabriel Bortoleto, a young star. Do the younger guys pick this up faster? I mean, I see like Kimi is doing great, right? And Max is not. So is that about the changes, or?
Max is not, because he's not the fastest today on track, so he will complain. But I think that you said it right. We've got two drivers ourselves. Nico, almost 40, not so young anymore. Gabi,
40 is still young. I feel like 40 is still pretty young.
For a driver. How old are you? But so obviously we've got 21 and 40. But both of them are picking it up. Okay. Nico is very happy with the car's handling. He's enjoying that format. Yes, fine-tuning again, but generally speaking, he's enjoying as much as Gabi. I think at the end, we just need to get used to a different format to before. And that's everyone. It's always true when you go through a change of a transformation. So we need to get used to it. But again, 3 races only, and the show was there already. So we should be positive.
What do you think about the new entrance? You know, my partner Hannah was always telling me, like, wow, there's so many new teams coming to F1, and it took me a while to sort of clock it. But now you have Audi coming in, you have Cadillac coming in, you have Ford coming in. Like, it's a whole new paddock, really, and good for you because you wouldn't want to go to Mercedes and McLaren. What does it mean to you to have more teams?
It's great, and it's showing again how the platform is attractive, no, to manufacturers and automotive. It's creating a great business at the end for fans, for automotive, for manufacturers, for everyone. And the fact that Audi has been attractive as much as Cadillac or Ford are important signals. So, and the fact that we are here today, by the way. So at the end, I think it's great to see that business, which is a sport we should never forget, is so attractive to everyone, because for us that we are working there, at the end, it's make our days even better, funny.
But by the way, what is it like for you as an engineer, a trained engineer, to deal with so much business stuff? Like, I was listening to Mario Carbone yesterday on stage, and I'm thinking, this guy is a chef, like he's a cook at heart, and he's talking about buying and building hotels, right? So it's a totally different skill set. And for you, it's the same jump, right? From designing an engine to convincing a sponsor to pay you money.
I think it's very similar. I was a poor engineer selling smokes. I'm still selling smokes in my business. It's about telling the right story. It's about convincing people. It's about motivating people. And I think you can do that from an engineer or, let me say, more a manager's side. But at the end, it's a team effort. It's not individuals. I'm part of the team as much as all the other individuals. We've got different roles, but I think we are all together. So it doesn't matter what you're doing. Simply stick to the objective and do it together.
I mean, I don't think many people could do it. So you could give yourself a pat on the back for that, because it's difficult to wear both hats successfully. So I'm very excited for this race. There have been some slight changes to the regulations. It's pretty technical stuff, but how would you explain the changes that we've seen, and how do you think it's going to affect your drivers?
I think, as we said before, it's fine-tuning, ongoing. I'm sure it's not the last one we will have. So based on the first initial 3 races, we have decided what could be improved in the short term, which is somehow reducing, as we said, the energy management by reducing the harvesting opportunities. It's reducing maybe the boost in overtaking to create less unsafe situations. But when you come to technicalities, it's a lot of details, which I don't think that the fan will recognize from outside. Maybe more the drivers being less affected by some strange behaviors or strange energy management situations.
No more super clipping.
No more, a lot reduced super clipping. So less, let me say, comments on it, which will help for the sport. But it's not big changes. It's really fine-tuning again.
How do you think you're going to do in Miami? And how important is this, U.S. exposure? Because now you have Miami, Las Vegas, Austin. It's huge.
It's huge for us. It's huge as well for our market here in the USA. So it's important one. But we should not forget, Audi has joined with a clear ambition is to win or aiming to win by 2030. As to create solid foundations, it takes time. Hiring people, creating the infrastructures. So that's our very first year. We are building and growing and learning. So my expectations need to be managed. So if you look at the start of our season, it has been okay. Fighting the midfield, scoring points in Australia. Big competitors are doing worse than us. So making it wrong in F1 is easy. So I think that by having started in the right position, no fundamentals problems with the car is great for us, but it's not the year we are aiming to win, not yet. That will take time. So, but scoring point and trying to do well is important to us. And again, being here in Miami after the first 3 races, again, to show the potential of our car, we have always been fighting for points at the end in the race, being in the midfield, but with a great pace. Again, to continue showing that even through the season, when everyone is bringing developments and we're bringing developments, we can keep that level of competition. That's very important to us for the credibility of our project, because from here onward, we always need to improve ourselves. We've got an objective to win, so we need to progress. But it's in F1, patience is required as well. It takes time. It's sometimes changes take a while. If you are hiring people, they need first to realize where they're living, where they're working, the environment. If you are building infrastructures, it may take years. So for us, being here in Miami, Austin, Las Vegas, as you said, is important, certainly, because finally we are here as Audi. But we need as well to look ahead, making sure that we are not distracted by our long-term focus, which is 2030.
Mattia, thank you so much for spending the time. We really appreciate it. Mattia Binotto.
That was Matt Miller with Audi's F1 team CEO. I'm Yahaira Anand in New York. We will go back to Bloomberg House Miami in a moment, but for now, let's get a check on the markets on this final trading day of April. We are seeing an S&P near the flat line, kind of a shocker given all the earnings we gotten this morning and last night, but speaks to the divergence that we're seeing among the tech heavyweights. Speaking of tech, we are seeing a NASDAQ down 0.4% with Meta the biggest drag there, and the 10-year yield down 3 basis points at trading at 4.39%, reversing yesterday's gains after the Fed meeting. And we are also seeing Brent crude easing down nearly 3%, trading at $114 a barrel. Let's go back now to Bloomberg House Miami, where Dani Berger is sitting down with Orlando Bravo, Thoma Bravo founder and managing partner.
Is it comparable to anything, or is like the stress, the anxiety that investors and markets are feeling very unique?
Oh, we've been through a lot. Remember, we're a product in software investing of the dot-com bubble burst. And what happened before and what happened after were incredible periods of hope, uncertainty, just everything everywhere. What we did back then was we focused on the details. At the beginning, people were saying this, and then when the dot-com bubble burst, I had people throw on my desk articles that said software is dead, it's over. Don't do it anymore in 2021. So we've been through a lot of periods. The financial crisis was pretty crazy. We would see the bookings of our companies down 50%. I remember asking my mentor, Marcel Bernard, in the 70s, he ran many divisions of Motorola, best operator I've ever met. In the depths of the financial crisis, Marcel, how low can it get? And he said, it can go to 0. So we've been through a lot of periods. This one is really, really fun for us because we are learning so much, to be honest with you. You know, we have 100% of our time is in our day job. Find the money, find the deal, improve the deal, sell the deal. We meet with our companies every month from 8 to noon. They were just all here in our sessions of board meetings. We call it operating reviews. Extremely intense. That's 100% of our time. But now the other 100% that we've had to find over the weekends and late at night is learning all this. And how do we apply it to our business? And it's intense and it's really fun. If not, it gets boring.
It certainly does not sound boring. Sounds very busy. I wonder if in any of that, as you're learning, I mean, Orlando, you are always very candid in your strategy and when you've had to make changes. I remember we had a discussion a few years back when you decided to pivot away from crypto. You're always very honest on these things. I wonder if in this current landscape, you're adapting, but are you pivoting at all? Does the strategy need to change in any form as you think about a new world incorporating AI?
Not the strategy and the philosophy. Okay, what we are good at, our core competency, is our team is very, very good about investing in the highest quality assets that serve the enterprise in technology. And we're divided into all these domain teams. We have our fintech team, our healthcare software team, our identity cyber team, our network and firewall cyber team that have been with us for a very, very long time. So that's our one core competency that we do, I feel we do very, very well. The second one is we turn great innovators into great businesses. So innovators that are doing well, that are doing a great job for their customers, that are growing at rapid rates, they're usually not making money when we get them. So we need to make them into private equity fundamental investments that earn 40% margin, et cetera. So that kind of stays the same. The tactics of how you do it and what you focus on, they change about every 3 to 5 years. And they're changing wildly now. The main one is we have had to make our companies very, very quickly AI-centric companies.
Right.
And take some risk on that and invest a lot of money on that and experiment on that and move very, very quickly on it. And that's new.
That feels like almost an impossible task just given how quickly everything is changing. And I'd imagine it's hard to find the talent for that, just considering all this stuff. Yes, AI in some form has been around, but you can't find AI experts, I'm assuming, with decades of experience because this current iteration is so new. So how difficult is it to transform these companies and find the right people to do it?
You know what? What a great question. Since it's all new, you cannot talk to a person that has been doing AI for 25 years. Tell me how this stuff works, right? So you think about the talent, and the nice thing is software and AI are not two different worlds. They're not two separate communities of people where you have the AI people here and the software. They're all the same. They're all developers. They're all providing these solutions. They're building models. They're building software to make those models work. That's what agents are. So the way we look at it is we have 20,000 engineers across 77 companies. Those companies are worth about $300 billion. It's right underneath us. But it's been an incredible amount of work to identify the talent within that group, coordinate them, put them together, give them the right incentives and the right goals in order to move these companies forward.
Surely, though, they aren't all winners, and they can't all be winners. And just the elephant in the room, Orlando, is Medallia. And this obviously predates some of the AI scares. And again, here you've been very candid. You've talked about overpaying for it. There have been some discussions about lenders taking back the keys. Where do those discussions stand now?
I think they'll probably take back the keys. We are not interested in putting more money into the company because we have to be disciplined about that. We could do it, kick the can down the road another 5 years, pretend like it never happened, but we have a big fiduciary duty to our investors. And with that amount of money, we feel we can earn an exceptional rate of return given what the markets are doing and what we're seeing in other things. But going back to Medallia, we do make mistakes. In every fund, we usually have 1 or 2 companies that don't do well. We take that so seriously. We actually end up spending more time on the companies that have issues than on the winners. For VCs, that doesn't make sense. But for us, we have this implied contract with our LPs that will try to save every single penny. I was on that deal. My partner, Scott Rubner, was on that deal. We had the management committee on that deal for many years. Now, our investors have known about the issues of Medallia and the mistakes we made for 3 years now. It's been written down at a very, very low level for that time. And the beauty, one of my favorite things about the business is our partners, our investors. We've been together with them for 25 years, and they look at the totality of our luck and our mistakes together. And that's just a beautiful thing in our business.
What about on the lender side? Is there any frustration that perhaps they're not giving more leniency?
Same thing with the lenders. You know, the lenders we have on the deal are the best lenders. They're incredible lending partners. We just financed a deal for a company we have called Octane. After the market dropped and after there was this scare in private credit, we raised about $5 billion for the company in this new market from many of the same lenders. Now, we had to go really wide. We went to like 133 lenders. That's why we have a capital markets group. Right. But they also look at everything in its totality as well and have a lot of experience.
By the way, just on that, has the cost of capital changed for software companies? Are you having lenders, for example, charging more just because of some of the fears and the headline risk?
100%. Like the markets behave relatively efficiently. And if you look at the cost of debt, it's about 250 basis points wider than it was when there were no issues in the market or no perceived issues in the market.
Do you expect that to normalize, or is this a structural change?
You know, it's a little bit of what's going on with employment, with layoffs, with other things. It just got so cheap as well. You know, how do you discern it between perceived issues now or what could happen to companies versus the fact that it went as cheap as 350 basis points over SOFR? There was so much money, and there still is, in private credit, and so many private credit funds chasing these deals that the cost of capital was almost nothing.
So that was the part that was out of whack, not this current period. This is more normal.
Look, I think when you look at it and you look at the cost of credit now in a competitive market, the creditors are earning about a 9% yield, unlevered. You could say that's about right when the equity needs to earn 20% plus in a levered deal. It's not like it's crazy. It's certainly not near where it was in the financial crisis. There was no money then.
Right.
You could just not even get it.
Right. Just one last question on Medallia, because, you know, as you said, your investors knew about it for some time. They understood that you marked this down. It is quite a large hole if we're talking around $5 billion. How do you think about the rest of the portfolio and essentially saving that fund if it does take a big hit of that size?
Oh, we have some great winners in that fund. We have a much bigger investment than Medallia and Proofpoint. And when we bought that company, it had about $250 million in earnings. It's doing above $1 billion now, and it's absolutely crushing it. So we have enough going on in the portfolio to be able to bury some losses and some mistakes that we made. Now, when you look at our total check in the deal, that's not all us. We are less than 50%, you know, of the total in that deal. So we also diversify. Now, the numbers are very large, but the percentages in each company in every fund have remained the same since 2000 when we had a $500 million fund.
Right. You know, a funny thing has happened post-COVID that everybody was trying to say every company they were investing in, it's a cloud company, it's a software company. Everyone wanted to tout the tech exposure that they have. And now every earnings report from the big major public players, they're saying we have no software exposure or we have very little software exposure. You obviously know this industry better than anybody. Do you think these funds are being honest, or is there some kind of analog washing going on that people are saying, this is a healthcare company, but maybe it actually is a software company? Do you think that the exposure out there is larger than most funds are willing to admit?
Oh, 100%. There's some gamesmanship around it, right? People are that have healthcare software companies, now they put it in the healthcare bucket, or a fintech company, you put it in the financial bucket. Now, there's some games around with that, but it's also a true fact. Both can be true at the same time. At the end of the day, many industries are becoming software companies. And now with AI, they're becoming intelligent software companies. And when you invest in these spaces, you kind of move with the industry itself. I think what people are missing is the beauty about software and AI, and they will come together. They will be no difference between either in the next probably couple of years. But what people are missing is if you take any industry, any process, any function, over time, there's 2 to 3 technology companies that capture the entire knowledge of that industry, process, or function. And they see how operators in it make mistakes, how they do things right, how they innovate, and they put it all together in one place. And those players that collect 30 years of domain knowledge are so much more valuable than the industry around it. That was true 25 years ago when we discovered it and nobody would touch it in private equity. That is even more true today. Domain knowledge and that experience that's captured in these companies is worth so much money. Now here's a debate. Young AI companies will tell you that experience is garbage. Because now you can take a young person with access to these great models and they can find a better way. I don't believe in that. When you get down to the details of our companies, Coupa, a $1 billion company doing procurement, all the exceptions, how operators work in procurement, their challenges they have, you need a lot of experience on that. Dayforce, managing the payroll of union workers that get paid by the hour with union contracts all over the world, 100,000 employees, the knowledge that they have will run circles around this generalist stuff. Now, I also agree with the young generation experimenting because that's the beauty of technology. Maybe in some cases you can find a better way of doing things. Both can also be true, but that experience and domain, I think it's worth a lot of money.
In this world where AI and software become one and they become indistinguishable, what are the roles of the big LLMs? What is Anthropic, Google, who I know you have a partnership, what sort of does their enterprise-facing arm look like in this world where the lines start to become blurred?
That's evolving. Now, if you look at Amazon, Google, the hyperscalers, even to a certain extent Microsoft, even though they go up in that layer, they have learned from experience that they're going to be the infrastructure providers to these domains. They're going to go horizontal and capture the entire world, all the way from chips to the model. Now, who implements that and helps companies do that? It's these domain-specific people that have captured the whole knowledge of their domain that then go to a company and spend 9 months with them saying, what's your problem? How can I save you money? How's your infrastructure? How do you work? How are you organized? And then you adopt a general technology solution to that specific problem. Then you need to implement it. And then you need to make sure they're using it correctly, and then you need to serve them. And that is a tough business. You go deal by deal, and that's a rough business. And that's what these players at the upper layer that we invest do very, very well. Now, there are some model companies that are saying, wow, that's really attractive. I'm going to form services businesses like OpenAI has announced and Anthropic has announced to go do custom projects for these Fortune 50 customers that can afford to spend $100 million, $200 million in a project. Will that work? Sure, that will also work. There are many custom solutions for companies. Accenture will do that. Other service firms will do that. No AI companies will do that. But also these incredible domain leaders, they probably will capture most of it.
That's really interesting. So basically the idea being, I'm trying to remember what the term is, but it's a type of engineer I know that maybe FDE, it's beyond my mind.
If you had FDE is a full-time equivalent.
Okay,
that's kind of what software calls it.
Okay, got it.
But if you change it to FDE,
okay,
forward deployed engineer,
I think this is the one
you can charge about 10 times for the same person.
Got it.
Okay,
so it's a marketing
you have a business. I see some people in technology here. That's exactly how it works.
Got it.
We now have 20,000 FDEs in our portfolio.
I see. So, okay, so basically the idea that Anthropic is going to hire all these FDEs and they're going to go out to companies and they're going to replicate some of the software, you're saying that's only really sustainable for the big companies that can spend that. But elsewhere, it's going to be these software layer companies that are going to be the ones that go in and lead expertise. Is that the right interpretation?
I think that's a good generalization.
Okay.
Because once you do all the change management around how to use these agents and what you need to do, adapt it to the company, do these big projects, capture their ROI, measure the ROI, which is a really difficult part. Like discerning how much of the ROI is coming from an agent, but from the fact you did something super smart, operating-wise, is very difficult. By the time you do all that, when you leave, somebody has to maintain it. Somebody has to change the data around it. Somebody has to work with the library. Somebody has to work with an ever-evolving environment. And then you have cyber. Who decides whether an agent has access to what data can they use, what data can they change, who is directing them, how are they being directed? All that environment is new. Right now, there's going to be some messes around it, but also companies will figure it out. But if you get a medium-sized company to do all that, and many of you may be in the room, you're not in the business of doing this. You're in the business of beating your competitor at your business, and when you do well, you worry about that every day. Take care of your customers. Who's competing against me? What's my price? Can I hire people? Can I retain people? Can I train them? That's your core. So a little bit of what's going on now is there's so much interest in AI as there should be, because it really will be transformative and it'll be good for the world. It'll be really, really, really good. And look how our lives are changing. I mean, we're going to have more people at Thoma Bravo. It's expanding, not less. The jobs of our junior people are getting much bigger instead of doing PowerPoint presentations and banging out a model for the 20th time. So it's going to be really, really good. But a lot of Silicon Valley is so in love with their robot and their technology that they think their customer will be just as in love with it. And you have to be really humble that they have a business to run, and this is about saving money for them, not doing projects for them.
Speaking of which, we only have a few minutes left, but I would love to discuss some more on your Google partnership, because it does feel like a lot of funds, private capital funds, are announcing various partnerships. What's the thought behind it, not just licensing something from one of these LLMs?
Well, we have a big partnership with the hyperscalers. That came from the software as a service days and has been growing. Google is the only company that has the entire stack, all the way to LLMs. And we have a great relationship with them, and they actually reached out to us and said, how can we work closer together? And we looked at it and we said, wait a minute, if we can get access to your FDEs,
how much are they charging you for that, Orlando?
Well, for us, no, it's a good partnership because they monetize our relationship in a different way. If we can get access to this as we quickly transform our companies to become AI-centric, and by the way, the new bookings of our companies are about 40% AI-centric solutions. It's eliminating the labor that works with our system in these domains. It's a new market that just appeared on our lap from this infrastructure that's being built. So if we can leverage that, and if we can get early access to their models, that'll be extremely beneficial to us. And if they can get our business, and you know what they're smart about? They know that our domains will drag Google with them to penetrate enterprises.
I was going to say,
so that's the partnership.
There's an element where it's not necessarily that you need them, but this is something that they need. It's not efficient for them to go out into every single individual software company and to try to pitch them instead of coming to you. I mean, is that a fair assumption that they kind of need you in this if they're going to reach more enterprise clients?
100%. You cannot, it's like my mentor Marcel Bernard would say, which applies to some of the young companies. If you try to do it all, you'll get to none. One day you cannot be an expert in distribution, the other day manufacturing, the other day consumer, the other day payroll, the next day procurement. It doesn't, the world doesn't work that way. And they want to be horizontal and spread their AI knowledge and AI capabilities around the world. Partnering with these domain leaders is a great way for them to do that. Now, a great example of how we try to move very quickly is we got a call from them with an idea. And we moved our 77 companies, and we were at Google with our biggest CEOs, the CEOs of our biggest companies, the following week on a Wednesday. And one of the heads of Google goes, do you guys usually work that fast? I go, actually, we do, because it's all about leadership and what you focus on, and this stuff is really important.
I would have loved to have been a fly on the wall in those conversations. Next time, invite us. I'm sure you'd love media there.
That would be interesting.
One to think about. Orlando, we're out of time. Thank you so much for joining. This has been such a pleasure. Everyone, please join me in thanking Orlando Bravo.
Thank you.
And that was Thoma Bravo founder Orlando Bravo with Dani Burger. We are here in Miami. I'm Matt Miller, just upstairs from where Dani and Orlando were sitting. We're at the Bloomberg House in Miami for a special edition of Open Interest. And I have a special guest. Thomas Gallagher joins me. He's chairman and CEO of Miami International Holdings, an exchange based here in Miami that has seen tremendous growth over the last couple of decades. They actually operate 8 exchanges here, and as part of a collaboration, Bloomberg and the Miami Exchange intend to launch futures and options and have a dedicated studio on the exchange floor as well. So I'm really excited to have you here, Thomas. Tell us, first of all, about your business and the growth that you've been able to crystallize
Matt, it's great to be here in Miami with you for Bloomberg House. So we have 8 exchanges that we operate globally, 4 U.S. options exchanges, And last September, we launched the first trading floor in the Wynwood section of Miami here called MyX Sapphire. So it's the first trading floor to be located in the state of Florida, and we're so excited to be here in Miami. So we also went public last August, and we were the third best performing IPO on the New York Stock Exchange last year. So we're very excited about that.
So, we talk a lot about the movement of Wall Street from New York down here to Miami, and surely from Chicago and L.A. As well, of just the finance industry. We're trying to cover it more and more. What kind of growth do you expect? Because this isn't going to stop.
Well, what started out during the pandemic as a temporary relocation has become a full-fledged migration here. Favorable tax climate, favorable political climate. I think our trading floor, which right now is about 0.6% of the national volume, it can grow because a lot of the floor brokers want to migrate here. They want to be part of this new Wall Street South. And the talent's moving down here, firms like Citadel Securities, which are a major player on our floor. So we see a lot of growth coming here, and also the opportunity to be in a jurisdiction that's very, very tax-friendly.
I mean, anybody working up in New York and moves down here gets essentially a pay raise automatically with the tax situation, plus the weather is a little bit better than it often is in New York. Who are your shareholders? Who are your financiers? Who's putting this together with your partners?
Yeah, so again, we have about a dozen market makers that also own our stock. Firms like Citadel, Susquehanna, Jump Trading, Wolverine Trading. We also have great backers. Warburg Pincus financed our growth in building this MyX Sapphire with a debt security, $140 million, which we just repaid out of the IPO proceeds. So we have some of the world's most sophisticated trading firms anchoring our four options exchanges. And now what we're going to do is we're going to leverage those relationships and the technology. What got us here, we're the 14th largest exchange operator, and we didn't exist on December 6th, 2012. What got us here was technology, low latency, high throughput, deterministic systems, and that's going to allow us to pivot from multi-listed options to futures products, financial futures, which we're really excited about doing that in conjunction with Bloomberg. We signed a 10-year licensing agreement, and our first product is the B100 that's launching on May 17th.
And we increasingly talk more about the B100 and the B500 than, say, other indexes that we usually used as benchmarks. What about the infrastructure down here? Because if you move big companies like Citadel and more people come down from Goldman Sachs or JP Morgan and all the floor brokers that you're thinking of, they're going to have to find a place to live. They're going to have to put their kids in school. Is there enough of a Greenwich, Westchester, Short Hills scene down here around Miami in order to house those people?
I think there is, but it takes a few pioneers to get people coming here. And I consider us a pioneer of the new Wall Street South. During the height of pandemic, who signs a 10-year lease for $20 million, about $90 a square foot, when I owned 400,000 square feet of space from the Minneapolis Grain Exchange, signing up a 10-year commitment? So when people like us come down, people like Citadel come down, and other financial services come down, and they see what we can do in this area, particularly with a great government and a great tax policy, it'll bring the talent. It'll bring the talent. So it takes people like us that are willing to make this leap.
It's no coincidence that we've also had now 5 years of Formula One down here. You've got a PGA event this weekend. There's an advertising conference. I mean, there's a lot of business going on in Miami, isn't there?
There is. I hooked up with Governor Bush over 15 years ago, and he said to me, Tom, I'm interested in being part of this. I said, why, Gov? He said, because I felt like in my 2 terms as governor, I had a lot to do with making Miami a cultural hub, a tourism hub, a medical hub. Never felt like I made it a financial hub. So you coming here, building the first exchange in Miami, I think will really anchor a great migration to here of great talent, sophisticated talent, technology talent, and I'm going to honor that commitment.
All right. Well, it's great to have you on the program, and I hope we can have you on more often. Thomas Gallagher there, Chairman and CEO of Miami International Holdings. Thank you all for joining us on this special edition at the Bloomberg House here in Miami. Getting really pumped for the race coming up this weekend. Coming up tomorrow on Open Interest, We've got a lot more for you, including Anastasia Amoroso, Emily Rowland, and Brunswick's CEO.